I worked on a video presentation for you to give the overview of things we had talked about. This certainly isn't going to be perfect by any means. I did do some numbers. This should get accomplished what we're trying to do. I did want to go over with you some of the things that we have learned as a company through talking with companies we work with and also some of the executives that we work with. And we know already it's a free agency market out there. There's no more pensions. The golden handcuffs, as we both knew it back 20 years ago, just aren't really around anymore. It's difficult to structure. So employees really just want to get all they can today. Not a lot of getting married to the companies anymore. Everybody just wants more pay. If they want more benefits, right now just kind of equals more pay. What do they really want? They want permanent benefits with the ability to save more, and they also want to be provided protection. Their biggest fears right now, and this is pretty much across the board, is the fear of a financial emergency and them having to dig into their retirement savings to cover something like that, not having enough savings to retire on, high medical expenses from some sort of a catastrophe, and of course outliving retirement savings. So most of the plans out there just aren't really taking care of this. So the question is, does your compensation package look the same as everyone else's? Kaizen is a solution to attract and retain the best employees just because of the way it's structured. Let's go back to the defined benefit plans. Everyone used to use whole life because of the guarantee so they could meet their numbers. The problem is the cost was super high. The long-term premiums that had to be paid were a liability on the balance sheet. Everyone switched to defined contribution plans like 401k matching and moved all the risk over to the employee. So the employee liked it because now they have control of their money, but they seldom save enough. And of course, who they're going to blame? They're going to blame the company they worked for. Well, they didn't pay me enough. They didn't set up anything for me to help me in my retirement. All their money is at risk. They're learning this right now because most of the money's in the market in these 401k plans. The IRS also controls contributions, how much you can put in, and also distributions. Employees don't like that much anymore. Remember, they just started in the 80s, so people are just now starting to retire from that. It's not a true tax deduction. It's income deferral. This is something else that people are starting to realize as they take money out. It wasn't really a tax deduction. They're just deferring the income. Then there's stock ownership plans, which are kind of popular with medium to not the super large companies, but medium size. And the problem is these are seldom funded by the corporation. So it's actually a long-term liability for the employer because we don't know who's going to leave when. And also it's a risk to the employee. They're depending on that company to perform well. What Kaizen does is it literally brings new money to the table, which allows some of these things to happen. So it kind of, we can set it up so it emulates a defined benefit. So we're actually targeting how much we're going to pay them in retirement, usually through a percentage of income, something like that. For the corporation, it's only a 5-year funding commitment. It's totally discretionary for key people, and it's flexible funding split. So you may have 20 key people, and every single one has a different type of an agreement or how you're funding this thing. And there's no ERISA reporting. It's non-qualified. As far as the bank loan for the leveraging, it's about 3-to-1 leveraging, not exact, but around that amount. There's no credit checks for the corp or the person, no loan documents to sign, no personal guarantees, no interest payments, and no credit reporting. So real quick, let's do an overview again of how Kaizen works. We use an IUL for the asset. Reason being, you can't use a stock portfolio. 50 cents on the dollar is the max. Of course, your money's at risk. Banks don't want a loan on it. Really, the only asset that you can use to do this type of leverage, this type of plan, is a life insurance policy. And later on down the road, we can get into why IUL and not whole life. But let's say, for example, client, corporation, whatever is going to fund in $80,000. The bank will turn around and match that first year. So there will be expenses come out, but there's still plenty of money and plenty of cash in there, even in the first year, to provide the collateral for the bank. So the bank's putting in 80, and so did the client. There's 160 been put in there. There's plenty of collateral, plenty of cash value in there to satisfy the bank. So this is why the bank likes it. Of course, the money's in the general account for the insurance company. That's who's providing the actual collateral, so the bank's safe. Now, after that, for 5 years, there's this one-to-one matching that goes on. So at this point, there'd be 400 put in by the client, 400 by the bank. Plenty of collateral there. So at this point, now there's been enough cash has built up in the policy that now we can actually have the bank fund both sides of this. So in this case, bank puts in 160 a year for another 5 years, for another 800 for the bank. Now the bank's put in a total of 1.2. Add that 400 from the client. Got 1.6 going to work. Now we're going to pay back that bank loan, but still we have a lot more money going to work in the plan. So let's look at a specific scenario. Let's say a company is going to pay a bonus to a client, 5-year bonus schedule, total of $400,000. That money is taxable to the employee. So let's say 37% tax bracket, and these are rounded off numbers. Let's say that employee nets $50,400. Okay, so over 5 years, they're actually getting $252 of that to go into the Kai-Zen. So we add the leveraging with that. Now we've got $262,700 going to work, which makes a significant difference in total income. So let's do an actual comparison. Male age 40, take the $80,000, and if we were to take that money and it was an after-tax investment, so he paid the tax, $252 left, puts it in some sort of an after-tax, and he's getting 5.64% growth rate every single year, no lost years, flat. He'd end up with about $40,800 for age 65 to 90 as far as income, with a $1 million total of total income. And that would zero it out at that point. If we were to go into a qualified plan, whether it be a 401k or however that's structured with the company, it'd be a little bit more income, $51,000, and that's with all the 400 going in, total of 1.3. So not a lot of big difference there. Now, if we were to take the 252 after tax to the employee and put it in just a straight IUL, and what we do is take the same IUL product all the way we trimmed it down, but without the leveraging. That would end up at $73,000 a year. So that's a huge jump in income. And of course, remember that's tax-free income. So we end up with a 1.9 total income, but we also pick up, and at age 90, estimated left for the employee, still have a $300,000 death benefit. So we add the leveraging to that. Now we're going to jump it up to over $150,000 a year from age 65 to 90. Still just using the 252 because it was after tax for the employee. Now we got $4 million in total income. So it's a huge difference. One, we know it's better going to an IUL because of taxes and a safety, no risk of the money. But then when you add the leveraging to it, it really makes it work. Now, all we do with doing an enhanced split dollars, what we talked about was everything's the same as Kai-Zen. All we're going to do is turn that into a split dollar, which will do these things. We take a bonus to the employee, now becomes pre-tax, not deductible, but it's a pre-tax to the employee. So the bonus expense down the road is recovered by the corporation. The bonus becomes, during that time period, a receivable asset to the corporation. So how does that work? Okay, here we had the sample I was using, $80,000 a year put in by the corporation, client, whatever. So we're going to just use this. What would happen is instead of that $80,000 going to being paid to the employee, they pay tax on it, and then they have what's left to put in the Kai-Zen plan. We actually make that into a loan to the employee. So what does that do? Well, here was the first numbers we had. We had the bonus, so the $80,000 net of tax, and that's what we ended up putting in the plan. When we do the loan with the split dollar, we have the $80,000 loan, but there's no tax on that because it's a loan to the employee. So now the full $80,000 goes into the plan, plus the leveraging. Now we end up with $1.5 million going to work for the employee to make money for his retirement versus less than $1,962,000. It's a huge jump in how much money is actually in there on tax-deferred growth. So let's do this again. I'm going to go through, and when we compare the Kai-Zen to the Tri-Zen and doing the enhanced split dollar, I've increased the annual income to 255, jumped it up 100 grand, but instead of 65 to 90, I've made it 65 to 80. And the reason I did that in this example is because we're going to cut off the income at 80. We need enough death benefit in there or enough cash in there to pay off the corporation because they're going to get reimbursed. And I'll go over that in a minute. But the employee still ends up so much better than even a straight IUL. So all they're really going to realize is this to here. Huge difference in income. Now, we could make this to later years and just lower that amount. This is just one of a million scenarios we could do. Now, this is all flexible. Net to the employee, death benefit after paying off everything, corporate and everything, is still $3 million. So he's picked up a lot of death benefit in this design. But here again, we can design it a lot of different ways. It's very flexible. So let's look at this again. Another thing we can do is, let's say the corporation is paying out that $80,000, okay? They're actually out of pocket after their 21% rounded off, about $63,500 out of pocket to the employee. So we can actually just lower what we're actually bonusing to the employee, not going to pay tax on it, to that $63,500, no tax on it. Add the Kai-Zen, we're at 1.2. So we're still way ahead of the game, even if we were to drop that bonus down to make it so the out-of-pocket expense today is the same for the corporation. So let's go here. What happens now? What do we pick up for the corporation? We've got a loan to the employee in this example of $400,000 over 5 years. And that $400,000 becomes a receivable asset because it's a loan. It's going to be paid back. We have to charge per the IRS the applicable federal rate, which is AFR interest, which changes all the time. Code 7872. Right now it's a little over 2%. So how do you get that money paid back? You have to have some source so it's going to get paid back to even qualify to do that as a loan to the employee. We either get paid back through the death of the insured, or we can actually structure a date. Those are the two ways the corporation is going to get their money back. So let's look real quick at the benefits of doing this on the employee side. Okay, if we did a max fund IUL, no leveraging, we already did those numbers, ends up with about $73,000 a year, 65 to 90, with a net proceeds at age 90 of $300,000. When we do the Kai-Zen, if the money were to go in the Kai-Zen plan and we leverage it, now that jumps up to 156, income 65 to 90, total of 4 million income, and we end up with about $1 million in net proceeds, net of everything, for the employee at age 90. So when we do a Kai-Zen plan for the employee, now they're getting more money put into the plan, which of course in this case 65 to 80 is going to increase what his income is. Now we may be doing an adjusted plan. So if we did the adjusted plan and put in the 63.5 instead of 800, which was the same out-of-pocket expense to the corporation, we still have significant numbers. Now we're still up to $200,000 a year tax-free income to the employee. Now this is kind of an example just to show you how it works. Now let's go to, excuse me, the corporation as far as how it affects them. We've got the 5-year bonus at 400, out-of-pocket expense, the 317. Just do it into a straight bonus. Of course, there's nothing coming back to the corporation. That's just all expense out of the door. If we do a Kai-Zen, it gets bonused. So it makes a big difference, but the expense out of pocket to the corporation is still going to be the same, but it's a lot better for the employee. Now, with the Kai-Zen, now there's 400 going out, but we're also putting that as an asset account receivable to the corporation on the balance sheet. Now, I just did some quick calculation. I know AFR is 2% right now. I just calculated this at 3. If you were to get that money either by death or a structured payout, when that client's age 85, corporation would be at 1.4 million when their original investment was 400,000. At age 90, if they waited till age 90, either death or structured payout, it'd be 1.6. So the corporation actually has an investment here that's on the books. Now, if we did the adjusted amount, then that drops down a little bit, but we still have 1.1 million coming down the road, or 1.3. Of course, death at any age could happen when he's 60 or 65, and that would, of course, affect those numbers. But that death benefit would always be structured, so there's plenty there for the corporation. So how do we kind of go about calculating some of this when we're just doing some quick numbers on a plan? NIW has developed this portal online called ILIA. And this is absolutely fantastic. This integrates information from the insurance carriers we use. We can select what carrier we're using, and all kinds of information is in here, but we use it for quick estimate benefits. So let's say you have an employee that's making $300,000 a year, and you want to set something up for him that he'll get 80% of his current income. So at 37% tax, he's netting 190. That's at 152 at about 80% of the income. So that's our target, is around 150 plus. So let's take that 40-year-old. Let's plug in the numbers, and he's in good health. Now we're going to do this backwards a little bit. Let's put in 60 grand of 5 years for you to put in, employer, and let's see where that goes. Okay, we're going to get the calculations. We're going to go to benefits distributions. Okay, income from age 65 to 90 shows 188. Our target was 152, so it's a little bit high. So let's go up here and drop down the contributions corporation makes. Calculate it again at 50,000. Now we're at 155. Okay, that's close enough. So now we've got income from 65 to 90. Corporation is only putting in 50,000 a year for 5 years to provide 80% of his current income for 25 years. That is a heck of a deal. Now, what's really good about this is when we have groups that enroll, whether it be association or corporation or whatever, we don't have to do necessarily everything one-on-one. We get them to log in. They can go in here and do their own calculations. So let's say that 40-year-old says, well, he's gotten educated, this thing works great. I think I'm going to put in another, what happens if I put in another 30 of my own money? Just simply knows what the corporation is going to put in. He adds his own money to it. Oh, let me that's actually should be 80 total. So now, instead of 155, he's jumped up his income another 100 grand by just putting in his own 30,000 a year for only 5 years. So now that the corporation has funded most of it, all those charges are paid, all that money just goes right into his cash account. We also use this for an educational portal. So when someone goes in here, it's not just the estimate benefits here, which is, let me show you this second tab here, comparisons, which is great. They have a bar chart, but I like the numbers. This actually shows them putting in the total money at the 80,000 is what they put in. And it shows them tax-deferred investment versus after-tax investment. The same index life, exact same thing without the leveraging, and then with the leveraging with Kai-Zen. So they can go here and see what their IRR is, what their total distributions taken out would be, and their initial death benefit, of course there's 0 over here, and their estimated death benefit remaining at age 90 after distribution. Now, are these numbers guaranteed? No, they're not. But once you understand our stress testing and all the buffers that are put in, the probability of hitting these numbers is extremely high, even per the insurance companies feel the same way. But when someone comes in here, they can learn a lot about Kaizen and how it works themselves, where we have tabs over here. We have a product tab, which talks about what an IUL is, how it works, how the leveraging works. They're not signing on the loan documents, what we do to minimize risk, which is the stress testing, plan details, what's the actual process that this takes place, and then down here, my favorite is the facts. And this is different information on different questions and subjects. And we get all this from actual past clients as they ask questions and tell us what they're really interested in. We get feedback from them, and this gives them a lot of information. So the final thing we use this portal for is down here, and it's not active right now, is enrollment. So once they click on this, instead of going to the insurance company directly and doing the application there, it's actually all done through the same portal. So they click on enrollment, all their information is put in there, they upload their tax returns, whatever documents they need to qualify for the life insurance amount, and everything's done online. So all this information then goes out to either the insurance company, bank, whoever else is involved in the case. It's all done on one source. So this will be their go-to place to know what's going on with their policy, to see their money going in, their growth, all that. We're integrating everything into this one portal, which this makes it very simple and very easy to enroll numerous people at one time. Now, one more thing I should point out is this income from 65 to 90, this number here, this is income tax-free via policy loans. So you don't have to really worry about the income taxation risk when they retire. And of course, you can calculate it any way you want. You can do that before tax, after tax, whatever. But that is an important feature, is that this income that they're looking at is income tax-free. Okay, so let's move on to the next slide here. I think that was a nice overview, just to show you how ILIA works. It's a fantastic portal they've designed. They spent a lot of money doing that and integrating with the insurance companies. So the one thing about this, the structure works where the corporate contribution becomes a loan to the employee, and so does the employee contribution. So if the employee wants to kick in that 30 grand, for example, so that actually, instead of going out here, it actually goes as a loan here. So now all of that money is loaned to the employee, and it goes into the Kai-Zen Trust. So why does that matter? Well, if the corporation was contributing the full $80,000 and the AFR was 3%, then that's what they would be earning. But if the employee contribution is $20,000 and the corporation is contributing $60,000, now the earnings on the corporate contribution go up. If it's a 50-50 split, now the corporate contribution on what they put in is actually doubling what's being earned on that, so on and so forth. So the way the ILIA structured everything to encourage people to actually put in some of their own money, however that's structured, is a good thing for the corporation, because it all becomes a loan, becomes a profit center. Okay. One of the best things about this is design flexibility. The old golden handcuffs kind of comes back into play here. We've got a short-term 5-year commitment for the corporation, less corporate funding needed with Kaizen because we're leveraging. So to get the same amount that you needed for that employee, maybe 80%, 65%, whatever you're going to do, is a lot less the corporation has to put in because of the Kaizen funding. Of course, Kaizen adds to it if you're going to go that way. So the employee is locked in for 5 years. Then what you do is you can renegotiate or reset another 5 years. So for example, let's say the first round, you're saying, okay, we're going to calculate 30% of your current salary, and that's what we're going to put on the table. You can put in more if you want. Then the next 5 years comes around. Is the employee working out? Are they doing a good job? Whatever. Then you renegotiate. Second round, okay, this time you're going to pay 50% of current salary, and then they just stack. So this is one way that you're setting up a commitment for them that now they've got retirement funding, whatever happens to them. So they're happy. It's a permanent type of a plan. But you're not committed to that employee to keep paying that for more than 5 years. So you can turn around and then maybe they like it enough now they're going to put in more money. So everything is flexible. Whatever's decided to put in that first 5 years, it has to stay the same for that 5 years. You can always stack a second one on top of that. So if you're using Kaizen, generally the Kaizen is going to increase the income 60 to 100%, but they can do Kaizen with or without the corporation. So they can go do it on their own. They don't necessarily need you to be able to do Kaizen. Now with Trizen, the enhanced split dollar, it increases the income same as Kaizen. If you're matching if you're doing it reverse, we're going to figure out how much needs to be put in. The increase really won't jump from that. It's 60, 100% on what's being put in. But with Trizen, because it's a loan, the corporation must be involved. So this is one of the big advantages here, because without the corp, they can't do this. And even their own money that they're putting in, if it's $30,000 or $50,000, they're not paying tax on it. So they come out way ahead. So now the corporation is really helping them. So it kind of locks them in on the split dollar.